Unless a major disruptive event occurs, central banks will print money, central banks will keep interest rates low, typical indicators will be ignored by virtually all investors, volatility as measured by the VIX index will remain low, and debt will expand and complacency will continue. Once you've established what are to be the likely events and activities in 2020, you can plan around them. A black swan event is always on the table and should always be on the back of your mind and should be a part of everyone's planning strategy. You came here for the truth, so let me unveil that for you. Today we're going to look at the 5 most important factors for 2020. From here, then you go out there and build on which that foundation has been laid. Most people don't do that. They don't look at the blueprints, they simply start building and building and building. But unfortunately, if they would have just taken the time to learn, to become more knowledgeable, then those things that come up later down the road wouldn't be such a big issue. But this goes for all different things in life, everything from building a home to investing. I want to talk about the central banks. Central banks will print more money, and you know this, of course, because this has become the name of the game. When we look at their activities over the years, it is very clear that they have tried to introduce more and more and more currency into the markets, one way, shape, or form. Generally, we're referring to this as QE, but you can look at the ECB, and they've got all kinds of programs, whether it's the CSPP or any other letters in the alphabet. We have the BOJ buying up all the ETFs, buying up their debt, buying up basically everything at this time. And it is interesting to note that we are now at $100 billion per month that they are purchasing in total with all the major central banks. $100 billion per month in a time we are being told everything is fantastic, the economy globally is doing just fine, markets are absolutely on fire. What is then the need for that $100 billion in stimulus? Seems very unusual, but of course, they're never going to tell us what's actually going on behind the scenes. Let's look at a couple charts that correspond to this data. You can see the global liquidity proxy and the S&P 500 from the end of 2019 up until present day. You know what has been happening. There is a complete correlation between these two. If I were to zoom out and see this back from the financial crisis up until today, in general, these two are mirroring each other. There's no doubt about it. If we exclude the United States, we get a little bit of a different picture, but ultimately it's the same thing. The United States has been the most prominent factor here. We have seen the valuations go absolutely crazy, but the fact remains, central banks are printing money, US stocks are rising as a direct result. So the Fed Vice Chair Richard Clarida was at the CFR, and he had a few things to say I wanted to bring to you. Most importantly, the Federal Reserve was prepared to add to its balance sheet, provide liquidity to the repo market at least through April. And we know that keyword at least will probably mean that they'll extend that far beyond. How long they go, who knows? Maybe they'll go all the way into 2021. Maybe they'll never be able to stop. That is something that we'll have to see in time. Clarida told me after the event that he was not concerned the markets could be taking advantage of the so-called Powell put, the belief that the Fed and Chair Jerome Powell are using the cash to stimulate the economy, or that they will cut rates to juice the stock market if prices fall significantly. This is his quote: "We realize sometimes we'll be criticized for it, but it's not a factor driving our decisions. We have a very clear mandate and we are focused on what we need to do." Clarida's speech was music to the ears of traders and investors who have profitably ridden a liquidity-driven rally that has allowed them to quickly overcome a set of shocks, and you know what we're talking about there. It's very clear what has happened over the last 10 years, where we have seen central banks intervening at a level they have never done in history, and this has directly resulted in asset prices rising. The expectation here is that this will continue. This is the repo market. The issue was brought up in September. Never before has it been this bad. As a result, the Federal Reserve intervened and they now are permanently in there, at least until April. We'll see what happens after that. This, of course, has been helping out equities, and there's no sense denying that. So if you want to know what's happening with equities in 2020, this is one key indicator to pay attention to. Central banks will keep interest rates low. I mean, obviously at this point, we know the name of the game, and that is to bring interest rates as far down to the ground as possible. You see the charts, you see it back in history. Essentially 1980, they spiked up extremely high, an anomaly on a historical basis, but essentially over the next 30 years, it started bringing them lower and lower. And at the financial crisis, they brought that all the way down to the floor. And this was a big issue because they couldn't take it any lower. They couldn't bring it below that zero bound. But some individuals thought it would be a good idea to do so. And whether we look at the ECB, the BOJ, some places in Europe, they found a way to get that to go below zero and ride with it for a little while. Now, Sweden had decided that after a few years of this absolutely insane policy, they would bring it back down to that zero mark and play with that for a bit. As far as I'm concerned, what are they going to do when the next crisis hits? Are they going to leave it at zero? Are they going to increase rates? I don't know what's going to happen ultimately, but this right here shows you that they are able to persist with low interest rates for a long period of time. People need to understand though how that works, and that is all with open market operations, and that is a direct result of the central bank intervening in the markets on a daily basis in order to keep it at that particular rate. This is a very unnatural rate, and so it has to be pushed down by printing money. Here's the Fed funds rate, which you can see going back from the 50s all up until today. Currently sitting at 1.55. If you look at a lot of the developed nations, this is actually considered high. This is very bullish to equities when you look at it because they aren't going to put their money in a bank account. They're not going to put it in that low interest bearing savings account right now. Why would they? When they can invest in something like an ETF, when they can buy something that will give them yield. And that's why we've had so much turmoil in the markets from 2018 into 2019, because investors had started to go around and seek more returns. But what are the options here? Now they're starting to talk about dual rates. You can see the dual rates in China, lending and deposit rates. The ECB may consider this as a potential option, but their toolkit ultimately consists of two things: printing money and interest rates. And they have brought interest rates down to the very, very bottom. We know for the foreseeable future, they're going to have to keep interest rates low. They're not going to be able to increase them. We saw what happened in 2018 when the Federal Reserve increased interest rates. It did not work out well at all. Typical indicators will be ignored by most investors, and you can see this historically. There's always euphoria, there's always a mindset, a herd mentality, and most people do overlook the important things. Just one example here, you could see the price of the Dow Jones compared with the earnings. And while we have seen earnings looking dismal, the prices have gone skyrocketing. And why? Of course, as we talked about earlier, the central banks have been printing up money. There are so many indicators, for example, the S&P price to sales, which have hit a record high. Never ever in history have they been this high, and that's where we're at today. It's quite crazy to think about. The stock market cap to GDP, also known as the Buffett indicator, has reached a record high as well. What's interesting about this is not just the particular price. You're not looking at this stock and seeing that it surpassed where it was before, therefore it's in a bubble. This actually takes into account the GDP. Now, the GDP itself might be manipulated, but when we see it as its own entity, comparing it to, for example, the stock market cap, that gives us a good comparison. Right now at the highest level we've ever seen before. But investors ignore that. They don't take this into account. They look at where the particular stock was yesterday or last year or 10 years ago, compare it to today, and that's all they need to know. Volatility as measured by the VIX will be persistently low. We have seen example after example after example of this, and certainly we have watched the VIX index getting pushed further and further down. It is sitting at 12.56, and despite all of the actions, all of the geopolitical problems that have been going on very recently, it has no impact on the VIX whatsoever. Many have asked why, and you can see the Federal Reserve's own website where they admit that they have a short volatility position. It is here in black and white. If you want to read that, of course, links will be in the description, but you can just see the chart yourself. When you see the VIX, despite everything that's going on, it's just calm and relaxed. And it's been at these levels now for quite some time. No matter what happens, if you look at it, the VIX stays so low. And just see, other than a few blips since January 2018 when things got really hectic, a couple times it got a little bit higher than what we see today, but for the most part, it doesn't even matter. It gets pushed down so easily. Debt will expand and complacency will continue. Whether we're looking at the US debt clock website, I'm sure you know about this, you got the US national debt and every other type of debt that is expanding to a record level. You compare the debt to GDP, you compare it to what individuals have, it doesn't matter because ultimately we are seeing it expanding at rates it never has before. This is very important, of course, because it cannot be sustained. But investors basically at this point ignore it. Look at the consumer comfort index, consumer confidence. Consumers in general are always going to spend until the very last minute. This tells you at least that the expansion of debt, when you're looking at credit cards, student loans, personal loans, mortgages, and so on, are continuing to expand until it's too late. They're not going to be an indicator to tell you beforehand. But if you see people spending like this, trying to keep up with the Joneses, that of course, at least in the short term, is good for the economy. They'll go as far into debt as they possibly can until it's too late. All of these things that I've brought up today are really critical to understand, not just for 2020, but in the future as well. If you keep all of these things in mind, it's going to be able to help you determine the direction of the markets. This tells you what's going to happen with a bull market, with a bear market, anything in between. But as I brought up in the introduction, a black swan event changes everything. Now, where could that come from? I've discussed many different examples, what many people have thought to be a concern. We don't know when that will happen. We don't know how it will happen, how it will unfold. Inevitably, it does. In the meantime, however, we can look at these trends as being critical to how it all will take place. That's all for this video. If you found it informative, hit that thumbs up button. I'm trying to bring you different types of content, but still remaining relevant. If you do appreciate that, hit the thumbs up. I really do want to thank you for doing so. If you want to build a business, if you want to learn about passive income, and you're interested in e-commerce, I created a free e-course to help everybody learn for free. It's at the AmazonGPS.com. The financial system is extremely important to learn because that's going to give you the knowledge you need to ask the right questions to your financial advisor, or if you're managing the money yourself, you're going to be able to know what's right and what's wrong. Check out my books at the link in the description if you want the audiobook, themoneygps.com. This is a 40-second video I just recorded. If you haven't seen it already, because it definitely will be blacklisted by you know who, this is going to tell you how to determine the direction of the market. It's literally a 40-second video. Click on it and I'll see you there.